Now this is a usually relatively easy step, but we've usually found that management requires a little bit of help in expressing their goals formally. So, a lot, well, some are not used to that. So the second major component are models of costs, and I won't talk about this too much because it's an area that most insurers are very, have lots of experience at. But just for those who don't come from an insurance background, I'll give a brief detail. And also in David's talk, he gave a great overview of how insurers model costs.
I wonder how much would someone have to
Well, no, I don't know if it's true, but apparently it was a problem with the GPS. But sorry. So the cost of the costs of an insurer obviously include the cost of the claims that they're going to have to pay out, the cost of administering those claims and administering the policies, and any other costs the insurer might have to do. And modelling costs is quite difficult, obviously, because they're quite uncertain. Cases like this have to be allowed for, or can be part of the claims experience. Usually it's done by modelling each type of claim separately. So you'll maybe have a claim for, say, storm damage. You have models for storm damage, models for theft, and models for other catastrophes like hurricanes or things like that. And each model that you use will be a function of many rating factors, such as the location of the home or the age of the insured. So I won't talk any more detail about this. And the final major component is customer demand. So the idea of demand models, or the objective of demand model, is to work out how the probability of buying a policy varies with price. Tend to build two types of demand models, one for new business, so for new customers coming into the portfolio, and another one for renewal business, so your existing customers and their likelihood of renewing. The reason of having two models is that I guess they tend to behave a little differently. So, for example, one obvious thing is that new business tends to be a lot more sensitive to competitor prices. And also you have different information about both groups as well. So you often have a lot more information about your existing portfolio than new customers. So you obviously can build more extensive models for renewal. So I've mentioned that competitor price is an important part of customer demand. And this, unfortunately, is a difficult thing in insurance because there's not just one competitor price, there's a whole range of competitor prices. We saw the range of quotes that we had in the marketplace. So understanding your competitor prices usually, not always, but usually involves building a model of their prices, so deconstructing their prices, collecting many quotes and building a model. That's an area which has its own difficulties and issues, which I won't talk about today, and we'll focus on renewal modelling. So I'll now move on to a more detailed look at building a customer demand model. So I'll be focusing on a renewal model, not a new business model, but many of the ideas are the same. Now there are five stages that typically we go through when building one of these kind of models. Most of them are fairly obvious. First of all, you have to identify the universe of possible predictors, then collect, process, transform the predictors. And then our first modelling stage is always building a tree net model. It's not always a tree net model, but that's the one that we find to work very well and to quickly give us a very good model. Then for final implementation, we then build a GLM model using some of the insights we've got from the tree net model. And finally, we'll assess the performance of our GLM model against our benchmark tree net model. So obviously the predictors we're going to use in our renewal model tend to be items that describe the policy or the customer at the time of renewal. And two main sources of these. One is the company's own database, and the quality and amount of information tends to vary from company to company. And also third-party information. So information that you can match by policy address or postcode or other geographic location indicators, things like market segmentations or socio-economic data. And typically the predictors will include the range of rating factors that we use to determine the cost of the policy, the prices offered by you in the past, and also the prices offered by competitors. Obviously indicators of loyalty such as other product holdings and years as customer, and any other details that the company might have on the customer, such as recent reasons for contacting the customer, the company. So once you've identified what you need to go and collect, you need to go and collect it and process it. The only reason I've got a slide for this is that those who haven't done it may not realise what a big task it is, particularly if you haven't done it before. It usually takes a long time. I often spend at least 4 times as long just getting data sets together compared to the modelling, so it can be quite time consuming. And the reason is there's lots of things to do. You need to extract and collect the required data, so if it hasn't been done before, you've got to write the extraction programs, and you've got to write programs to process the data into the right form. For example, much of the data you have is in a transactional form, so you've got to take that information and process it so you can use it. You may have predictors which have got many different levels, and it's often very worthwhile to consolidate the number of levels to make the modelling a bit easier. And then you have to decide what transformations you're going to make to some of the data, and the transformations of price and competitor information can help with the model building. So what I mean by transformations, probably not quite the right word to use, but I just mean other predictors that you derive from your competitor prices and your own price. And you get much better models if you do that rather than just feed the prices in their original form. Obviously, there are many possible transformations, and obviously finding the right ones to use involves a little bit of experimentation, and but the ones we've found to be useful obviously are how much the renewal premium has increased since the last policy term, some indicator of competitive position, and some indicator of how far we are from our competitors. So obviously, if you increase your renewal premium since the last one, the further you increase it, that's going to be bad for renewal rate. Also, the more competitively you're priced, the better the renewal rate's going to be. The predictor that we use for competitive position tends to be quite simple. For example, if your insurer is the cheapest, give it a label, position equals 1. But if you're the third cheapest, your position equals 3. So quite a simple predictor. And the other important one is how far we are from our competitors. And there are many different choices here. It could be the difference from the average competitor price, distance from the cheapest competitor, distance from most expensive. And again, the best choice will depend on the particular market that you're looking at. So when you combine all those predictors up, you end up with a demand curve which looks something like this, which is a downward sloping. Obviously, the demand for the policy is decreasing with price. So as price, this is an increase in price, you're getting a decrease in demand. And occasionally we see steps when the price passes different competitors. So having built your data set, we're now in a position to model. And our first step is usually building a tree net model. So it's a great tool to use. It usually provides us with a very good model with very little work. So under a day, you can usually get a very good model that's very predictive. And that model we often use as a benchmark for any further modelling that we do. And it also is important for variable selection and feature identification, which helps with building the GLM. So there's often many hundreds of predictors. So once you decide on the universe of predictors and collect them and build the data set, you often end up with a data set which has many hundreds of potential predictors. And TreeNet's very useful for identifying the important predictors. And I've used it in, I guess, a very simple way, in that just use the variable importance list to help identify the most important predictors.